Dividend investors, beware. Beware. You heard it here first from your old buddy Josh. So I want to show you something. So I'm reading this study from, let's just see, it's page 16, from these guys right here. I did a video on it yesterday. How the wealth was won, factor shares as market fundamentals. All right. And it got me thinking. And that's the smoke. My head's on fire. This lump of coal. All right. So that's the smoke you're feeling. All right. We assume that attaining balanced growth in capital requires the firm to invest a fixed fraction of its output beyond replacing depreciated capital. All right, so I just want to show you that for just a second. Shareholders received a portion of earnings not reinvested as cash flows. All right, so shareholders, you and I, us, the old good guys in the country. Everybody else, bad guys. We're the good guys. Again, we assume that attaining balanced growth in capital requires the firm to invest in a fixed fraction of its output beyond just replacing depreciated capital. And then we, shareholders, received a portion of the earnings not reinvested as cash flows. All right? I just want to reiterate. Shareholders received the portion of earnings not reinvested as cash flows. All right. The variable C represents a net payout defined as net dividend payments minus net equity issuance. It encompasses any cash distribution to shareholders, including share repurchases, which have become a primary method for returning cash to shareholders in the U.S. For brevity, we refer to those payments simply as cash flows. All right, I hang tight, my friends. It encompasses any cash distribution to shareholders, including share repurchases, which have become a primary method for returning cash to shareholders. That hit me like a ton, because I know we've had share buybacks. I know that has had a big impact on dividends. And it's here. It's going to be here forever. And as such, if you're just a dividend investor, you're missing out on these share buybacks. Let me show you what I'm talking about. I mean, not necessarily, but you just want to be very careful to focusing solely on dividend yields, because there are other ways to get cash from stocks, which is share buyback. So just check this out. We're going to go to old Grok here, and we're going to see right here. I say, Grok, how much S&P 500, how much buybacks did the S&P 500 actually, in terms of share buybacks or share repurchases, how much cash did S&P 500 company stocks use to share repurchases? The S&P 500 buybacks have grown exponentially over 40 years, from $10 billion in the 1980s to $942 billion in 2024. So almost $1 trillion in share buybacks have happened in 2024. I mean, dude, $1 trillion. You know how much that is? That's $1 trillion. I don't know how much that is, but that's a lot of money, a lot more than you and I have. So I said, well, what happened in terms of dividends? The total dividends paid by the S&P 500 corp companies were at $629 billion. So share buybacks were 33% more than the dividends. Isn't that interesting? Now, why is that important? Well, from a cash flow perspective, dividends are taxed twice. Buybacks maybe. Dividends are taxed at the receipt, because if a company's paying dividends when they're not making profits, that's dumb. I had a client, a lady, great lady. She was getting this big dividend payout. I can't remember the company. And I just looked at, and I was like, dude, this company hasn't made money for 5 years, but their debt's increasing. I said, look, I can't tell you what to do, but that would scare the living bejesus out of me. How are they going to keep paying those dividends? I mean, at some point, the freaking spigot's going to shut off on borrowing, and they're not going to be able to pay the dividends, and then the stock's going to drop like a brick of water. I can't remember the stock. I don't know what happened. I was like, So we're going to assume a company that's not living on borrowed time, that a company's actually making profits, all right? So a company can say, hey, we're going to make a profit, which they got to pay tax on. Then we're going to turn around and give that dividend to you, for which you have to pay tax on as well, at the receipt of the dividend, all right? At the receipt of the dividend. Now, obviously, it's in a 401k, a qualified plan. You don't pay tax on that receipt of the dividend, which is even worse, because now you're going to take a dividend that was normally taxed as preferential qualified dividend income, and now you're going to turn that into an ordinary income tax. Because if it's an IRA, deferred 401k, TSB, What was previously taxed as a qualified dividend, 15%, is now taxed as your ordinary income, 22, 24, and whatnot. Not good. That's a bad term. But either way, if it's a non-IRA and you receive that dividend, you still got to pay qualified dividend at the time of receipt. So you have to pay 15 cents, depending on 20 cents, depending on net investment income tax. Either way. Now, it could be zero if you're the 12% tax bracket, but generally speaking, you're going to have to pay tax at the time of receipt, even if you reinvest the dividend into more shares. The difference between a purchase buyback, though, is basically increasing capital gains. All right, so basically what they're doing is they're reducing the number of outstanding shares, which increases the scarcity, it decreases the supply. A decrease of supply does what? It increases the price. You're decreasing the supply, you're increasing the price, assuming the demand doesn't fall beyond the supply. All right, if the supply fell by 10 and the demand fell by 12, the price would fall. If the supply fell by 10 and the demand was still at 10, the price would increase. So that's just how it works. All right, if the demand fell by 10 and the supply fell by 10 and the demand went up by 12, the price would increase again. I know it's kind of hard not to visualize that, but just keep in mind, whenever you're reducing the supply, as long as the demand doesn't change much, you're going to increase the price. Now, the increase in the price in a stock here, you don't have to pay tax until you actually exercise that by selling the shares. All right, so you can let it just roll tax-free for the rest of your life until you die, assuming it's in a qualified account or not. It doesn't matter. It doesn't be tax-free obviously be tax-free to you until you die, but it won't be tax-free if it's an IRA or 401k to your heirs. At some point, you have to pay tax on that, grant you. But if it's a brokerage account, you never have to pay tax. You die, it goes to your kids tax-free within a step-up basis. Now, again, you could say, no, I want those. I need to exercise some shares because I got to buy, I got to friggin' get my wife a diamond ring or else she's going to leave me. All right. Well, in that case, yeah, you're going to have to sell shares. You pay capital gain tax, assuming you can't have some other losses to offset that. But either way, share buybacks defer taxes that you are now in charge of, where dividends, you got to pay the tax on it without question. And share buybacks too, by the way. I mean, there's long-term capital gains have the same tax rate as a qualified dividend. So if it's in a retirement account pre-tax, you're going to have to pay ordinary income tax as opposed to qualified dividends or long-term capital gain. It's the same way. But in this case, again, if you get the dividend, you have to pay tax on it. If you get the share buyback and it increases the price, you don't until you decide you want to, if that makes sense. Thus, you're going to see more and more share buybacks and less dividends, I presume. Now, dividends have gone up quite a bit, actually. I mean, I'll show you right here, going to my man, political calculations. Dividends, actually, the actual dividend went up from 1657 in 2000, 16.57 in 2000 to 76.74 in 2024, and that's 25 years. Zero payment. So dividends have increased by 6.5%, 6.6% to be precise. It's pretty good. That's pretty good. But at the end of the day, there's going to be less and less dividends and more share buybacks. Earnings have gone up by 49. Actually, I think they show us earnings increase, don't they? Maybe they don't. So earnings have gone up by 49 present value to let's see what that is. Earnings have gone up by 6.4. So earnings and dividends have increased almost identical to each other the last 25 years. And you can see the index return with full dividend reinvestment is 7.59. The index returns without full dividend reinvestment is 5.65. So in fact, if you factor that after inflation, if you're not reinvesting your dividends, you're leaving, I mean, hell, you're leaving 30%, 40% on the table for sure. But anyway, that has nothing to do with what I'm talking about. I just want to point that out. So if you're just investing solely in dividends, you got to be careful, man, because you could be missing out on companies that, A, don't pay a dividend or much of a dividend, who are using share buybacks instead. And share buybacks are simply going to be more, I would say they're going to be probably more, growth oriented than dividends for sure. Yeah, something to think about. All right, God bless. Smash that like button. We'll see you.